Hey guys, welcome back. In today's video, we are talking about how shorts are down $180 billion, how they're adding on FTDs, the AMC having a better upside, and many more in this video. First, we take a look at this. Breaking, short sellers lose $180.9 billion in 2024. I'm sure this has nothing to do with GME and how bad it will be after. So what we can see is understanding in terms of the situation the short sellers have got themselves into. So in 2024, they obviously lost 180 billion. But what we have to consider is that this is very likely what we are given on paper is their realized losses. What we've seen in the past is obviously how banks have only given their realized gains, and in actual reality is that whilst they have realized $100 billion in profit, their unrealized losses are actually in 300, 400, 500, and so the overall would have actually been in losses, but because they've only reported their realized gains, that's what we are given. And so if what we are seeing here is the fact that they're down 180 and it's only their realized losses and their unrealized is even bigger than that, then we can obviously understand that this is an even bigger situation that we can think of. And remember some of the things that they've done obviously this year, whether it's more loans, the fact they had to create more FTDs, the fact they had to take in terms of hiding their positions and take other ways of bailing out, we know that they are not in a good place. And so whilst we can see that they're down 180.9 billion, I do believe that the number is actually way bigger than that. And of course, most of that will come from the fact it's GME and AMC. And remember, some other things they won't mention is obviously the money that they use to create the synthetics of AMC obviously won't be counted in for the losses of their positions. And so there's a lot more of a hidden cost that needs to be mentioned, but it isn't mentioned. And that's why, like I said, I think the number is bigger. And the reason why I'm linking in AMC and GME together, well, when you take a look at this, remember May 13, 2024 was the day when Roaring Kitty reappeared with his first video tweet. AMC volume on May 13 spiked due to the same ETFs holding both AMC and GME that were being manipulated were affected. So like we've always known, like we've always talked about, the short sellers of both AMC and GME are of course mutual. They are the same short sellers, at least a majority of them are shorting both AMC and GME. And so that's why we know if they're losing money in GME, they'll be losing money in AMC, and obviously the vice versa as well. And like we've always said, they need to suppress both of them. Even if they let one run up, and for example, if they let AMC run up, then GME will run up shortly after. And again, the same applies for vice versa. And so this is why we've said the fact we understand that they've lost 180.9 billion obviously shows that they're losing money in both AMC and GME when we understand everything that's obviously ongoing. Another thing to obviously show this, and again, we're always talking about this right now, but it's just to really highlight what's happening. If revealing failures to deliver can cause significant harm, why allow it first place? It's literally admitting wrongdoing and significant harm to investors or the financial system in general. And so firstly, we talked about this. They didn't want to release the data of the FTDs for GME because they realized that it will cause harm to investors. And that's what we've known about how short sellers are losing money. And like we talked about, if short sellers are losing money in GME, they'll be losing money in AMC. And so when we understand this, we know exactly what's happening. But the very fact that they're saying that and allowing failures to deliver shows how the hedge funds aren't in a good position. Because we know that FTDs are used to protect hedge funds, so if we are seeing an increase in the use of FTDs, just in FTDs in general, then we know that the shorts need bailing out, that we know that shorts are in. Last year, what you will see is of course the FTDs of both AMC and GME to obviously be increasing, and there were days where it wasn't reported, there were days where data was extremely suspicious. So all of these are obviously highlighting that the shorts were struggling and they needed ways of trying to protect themselves from, of course, the squeeze the margin calls. And you can even see here the SEC has failed to collect $10 billion in fines after to stop reporting its collection data in 2019. They've also failed to release the real GME FTD data despite numerous FOIA requests. If they can't collect fines and provide real data, then how can investors be protected? Like we talked about, this is what's happening. They obviously are not here to try and protect the retail investors. They're obviously here to try and help the institutions. And again, this is why we're happy to see a new administration, is why we want to see more regulations in terms of things that will allow the retail investors to be on equal ground with the institutions. But you can see, and again, it's what we have to deduct from these hints, from these clues, is the very fact if they need the regulations to bend the rules, to turn a blind eye for these institutions, then it obviously shows that they are in a bad positions. Hedge funds and institutions would not need the rules to be broken if they were making tons of money, if they were in a healthy position. The only reason why they want the rules to be broken and bended for them is because if not, they will be, of course, in a very bad place. And that's what we're seeing this. And that's what we can obviously understand with the fact they're failing to collect fines, obviously showing that whether it's hedge funds that are running low on liquidity, whether it's the fact that they are just scared, the fact that they're not releasing FTD data obviously shows that there are a lot more shares that are out there that are not being settled, that have been created synthetically. And so, all of these are clues that we have to understand. And now, furthermore, when you dig into this, you can see almost $1 billion increase worth of FTDs in half a year for Citadel, like you guys can see here. Now, we know what the case for that to be. We know that Citadel is obviously some of the positions they're tied up into, AMC, GME, and most recently, of course, DJT as well. But not only that, you can see B. Riley had over 2 billion in shares lent out in May 2024. Another one would be 1.5 billion securities sold not yet purchased, reported by BNY. And again, another influential institution. Wedbush had over 2 billion in reported shorts as of February of last year, which is one of the many funds that they have. And what you can get from this, and I think is very important, is when you take a look at here, 1 billion worth of FTDs from Citadel, a big short seller of both AMC and GME. B. Riley, again, someone that have spoofed AMC in the past, someone that's shorted AMC in the past. BNY, we know with obviously what happened with them, and remember that Citadel has actually owned a stake of them, and the fact that they have 1.5 billion in securities sold not yet purchased. Wedbush, another someone that's affiliated with AMC short. We're seeing everyone who seemingly are shorting AMC have all increased their positions in shorts in FTDs. Now, again, we have to take the clues from what we get, from all the limited data that we can get. And with this, what we understand is that clearly there's something going on. If they're trying to increase their short positions in a time where what we see here, that short sellers are losing money, then what is happening? Well, it's very likely that they need to double down so that they are limiting their loss, so that they can suppress the market. Because clearly, the short sellers aren't making money. If they're making money, it will be short sellers are up 180 billion in 2024, not down. So if short sellers are down and they're still increasing on their short positions, then what does that tell you? It obviously says that they are trying to double down, like we talked about earlier, is the fact that they are obviously not making money, but they are still increasing, so they're in a very bad position. And these are what we talked about with obviously badly managing your money, in terms of over leverage, in terms of synthetics, in terms of suppression. This is what we're seeing. Now, this may be a bit of a controversial take, but I want to explain it further. So you can see here, AMC seems to have a better upside potential than GameStop, but still pinned and sentiment is mitigated regarding management team. Shorts and market makers using this to create FUD and justify where she's valued right now. Anyways, 450 is a critical level, need to play offense now. Like I said, this isn't the battle between AMC and GME. This is something that I've always clarified. Now, the reason why I'm bringing this up is in terms of understanding that right now, when you look at the fundamentals of both AMC and GameStop, we talked about the pros and cons. GameStop just has a way bigger cash pile than AMC. What GameStop doesn't have is obviously a working business structure, and that's what AMC has. AMC obviously has the fundamentals, the business structures that they're improving, their revenue streams that they've created, renovating, innovating, and of course improving. These are all things, and so that's the pros and cons. And so when you look at it from a fundamental investment side, obviously it looks like right now that AMC has a bigger potential in terms of how they can grow their business. But Like we talked about, GameStop has billions of dollars that they can use, and so they can also create a good thing. But another thing, and it's an important factor I want to talk about, and again, I'm curious to hear what you guys are feel about this, is the reason why I think AMC could have a bigger upside than GameStop is because there has been more synthetic shares created for AMC than there has been GameStop. And that isn't because they're, putting more money, but it's just because it's simply cheaper to create synthetic shares of AMC than GME when you look at the market price. Now, when you look at it this way, it's because it's cheaper to create more synthetic shares of AMC, they obviously are able to suppress the price more. But when it comes to the time to actually cover the shares of synthetics, then that's when it becomes, troublesome. That's when things start to get in. And so because they've created potentially 4, 5, 10x more synthetic shares of AMC than they did GME, when it comes to covering, it may be that obviously they are paying a higher price because there's just a lot more demand to be filled for the AMC synthetics. Again, these are obviously all up in the air, it's only my opinion. I am curious to hear what you guys think about this. But as always, guys, thank you for watching this video. I'll catch you guys next time.